Hello, everyone. This is Nick Katko from BMA. Welcome to today's webinar. Hold on. About lean quoting and pricing. First thing I'd like to do is the traditional tech check. I want to make sure that you can hear me, that you can see me, and you can see the screen. So if you can, in the question pane, just answer yes. And let me know if those things if everything's working well. All right, I got one yes, that's really good. So we'll get started with today's webinar. First, the sort of administrative pieces. If you would like a copy of the handout, it's available in the handout section of your control panel. You can download it. If by some chance you forget to do that, excuse me, or if you are watching a recording of this webinar, you can simply send me an email and I'll be glad to send a copy of the presentation along to you. Secondly, if you have any questions, please put them in the question pane or panel in your control panel, and we'll try to get to questions either during the webinar or after the webinar. If you are a certified public accountant in the United States and you would like to receive 1 hour of continuing education credit for this webinar, you have to answer 3 of the polling questions. You have to be logged in for the entire, at least 50 minutes. You have to attend a live event. And after the webinar, if you'd like the certificate, send me an email and I'll be able to get that out to you. I am doing something a little bit different. For those of you who have attended previous webinars, I usually just do 3 attendance check questions. I'm actually trying something out. I actually have specific questions related to the webinar. It's about you being able to maybe do some quick calculations on a adding machine or on your phone. And I'm going to pose the question. You can do the calculation. I'll keep it up on the screen. Then I'll show you the answers. Okay, but I'm just giving this a try because I think it's a little more fun than just answering the attendance check questions. All right, so last month we did, for those of you who attended, we did dealing with standard costing. And this webinar is a little bit sort of related to standard costing in the fact that one use of product costs in companies is to set prices. And this is the idea of cost plus pricing. And it can cause problems and issues. I'm going to explain some of the reasons why. In general, if you're using a cost to set the price or quote a price, the cost is not necessarily accurate. So you have a good probability of the price being too high or too low. And so I'll give you some examples about that. But there are methods to use to calculate a price or prepare a quote without using a product cost. And those are the contribution margin hurdle rate and contribution per minute. And I'm going to show you how you use those calculations. And I've worked with plenty of companies over the years that once they see this and they understand that it's simple and easy, but yet it provides the information people want to know, a lot of companies adopt it. What we're trying to do really is understand when a quote is being made, or you have to give the customer a price on an order, especially if especially if you don't have like list prices. How much money are we making? That's really, really the issue. And that's how the box scores come into play. And so we're going to look at that too, and then we'll wrap things up, and I'll give you some time to answer any questions. All right, so let us get started. So what are the problems of cost plus pricing? First, there's this general assumption that you need to have the product cost, or if you're in a service organization or service business, you need the service cost to calculate the price and understand how profitable an order will be or a quote will be. A lot of times this is done by sales and marketing people. They need it. Other times it can be done by looking backwards, how profitable is a certain line, things like that. The issue is that these costs are not accurate. Okay, product costing or service costing is a cost allocation system. Okay, you are taking costs, trying to allocate them to a product or a service. And one of the characteristics of any cost allocation system is that there are some subjective assumptions that have to be made in order to in order to allocate the cost. Again, these are subjective assumptions. These are not, you can do all the time studies you want. You can study processes, and you can have lots of detailed rates, things like that, but there are assumptions which have to be made. And we're not perfect. We make assumptions, and they could be right, they could be wrong, they could change. So when you look at product costing in general, one of the general assumptions as it's related to direct labor is that the amount of direct labor that gets assigned to a product is driven by the total production time. So that means the longer it takes to produce a product, the higher the cost. The higher the product cost is going to be. Okay, and what I'm going to show you is that, time doesn't drive labor cost. Okay, and the other factor is that overhead cost is driven by total labor cost. That's what an overhead rate does. It takes the total labor cost, uses the overhead rate, and like it's like 300% or something, and it calculates overhead. So again, the longer it takes, the more it costs. That's sort of that's an assumption. But the fact of the matter is that direct labor is not a variable cost. Okay, your full-time people, it's a fixed cost. Okay, and most of your overhead costs are fixed. So just in general, what you get is that, the more time, the more cost. Okay, and what that does, when you get into looking at profitability or quoting, you sort of get a lot of conversation within the company. Why does it take this long to make the product? Are the rates correct? There's a lot of questioning and doubting about it, because for example, sales and marketing or other people who are doing quoting and pricing are trying to do is they're trying to make sure that it's profitable. So they have a general sense of what the customer might accept as a price. So they're trying to work the cost side and lower the cost of the quote unquote product, or lower the product cost to try to get the profitability. All right, so these are the problems. Let's look at a few examples to make it more clear. All right, I'm going to get to polling question number 1 in a minute. I'll let you know when that is. So here we have a process. So there's a drilling process on a CNC machine. It takes 1 minute. You have one person working there. They work in a batch size of 2,500. Then there's a lathing operation on a different machine that takes 4 minutes. One person operates. Then there's a grinding operation. Again, one person, 6 minutes per unit. Then there's the inspect and pack and ship, 4 minutes by one person. So this actually, by the way, excuse me, is a real life example of a company we work with. So this is basic conventional production. And you can see on the right side, there's a lead time of 6 weeks, 25 days of inventory. You know, the batch size is 2,500, on-time delivery is only 82%. When you calculate the cost of this product, there's total labor time of 15 minutes. So the labor cost is 5, overhead cost is 15, a 300% overhead rate. You add in the material cost, you get a total cost of $21.50. So here's the first polling question, and you can answer this question based on what you see on the screen. I'm gonna put the question up. First I'll explain the question. So my question is, my question is, how many units per hour can this value stream produce? And everything you need is on that screen. And actually, you don't have to do, you can do the calculation in your head. So let me put the polling question up. So I'll put this up here on the screen. It might be hard to see everything. So I'll give you another 15, 20 seconds to answer. Then I'll show you the answer. All right. I'm going to close the poll. Actually, I'm going to share the results. So these were the result answers. And the correct answer actually is 10 units per hour. Let me hide the results. Got all these things going on here. The reason it's 10 units per hour is that the grinding operation has the longest cycle time, 6 minutes. And it's known as the bottleneck, might also be known as the pacemaker or the constraint. But it controls the rate of flow, meaning the slowest step in the process dictates the output. You can only make 1 every 6 minutes or 10 per hour. Okay, so now let's look. I just wanted to get that in place. Now let's look at a future state, okay, where we create a lean cell. So what we've done here, we have a drilling machine that takes 4 minutes, and everything, that's a new machine. It's a smaller machine. It replaced the CNC machine. The machine, the lathing, another 4 minutes, grind, inspect, and pack. So everything stays the same, except they replaced the machine. Now what happens? Okay, from a operating viewpoint, on the lower right-hand side, lead time 2 days, inventory 5 days, batch size 250, on-time delivery 98%. From an operating standpoint, this value stream is performing better. But from a product costing viewpoint, it's taking longer, And because direct labor cost is driven by the time, it now costs $25.50. More labor, more overhead because of the 18 minutes, 3 more minutes. But the output, 10 per hour, is still the same because the bottleneck has not changed. So you're still getting out 10 units per hour. You're flowing faster. You're serving your customer better, and you still have the same number of people. So your labor cost, the actual labor cost, really hasn't changed. So this is one example of how how using direct labor to calculate a product cost and the overhead cost, it makes it look like it's more expensive. So again, if you were pricing here, okay, we don't have the price here, but you know, your cost would go up, your margin would go down, and let's say you can't pass along this fake cost increase by raising your prices, you think that you're not making as much money because of this improvement. When the fact of the matter is, your output is the same, your actual costs have remained the same, you are making as much, the value stream is still making the same amount of money. So the lesson to learn here is that the bottleneck process controls the rate of flow, okay? And product costing does not take this into account. So let's look at another case study, and this is about overhead, okay? So we have a value stream here. We have 2 products, product A, product B, and you can see their processing time. Product A takes 17 total minutes, product B takes 24 minutes. But building on the bottleneck that we just talked about, the bottleneck of A and B is the same. It's 6 minutes, okay? Which means that the output of this value stream is 10 per hour. That can be 10 A's, 10 B's, or any combination of A and B, but the maximum output is 10. So that's how the value stream is operating. Excuse me. Let's look at product costs. So what we see here, using the product cost information that you see at the top, that product A has a higher standard margin than product B. Why does it have a higher standard margin? Product A only takes 17 minutes, product B takes 24 minutes. So product A has less labor, less overhead. Now, what happened in this situation in the company is that products that had less than a 30% standard margin had to be outsourced, okay? So hold on one second. So the polling question here, I'll say it and then I'll put it up. Product B ended up being outsourced. What happens to the cost of product A when new standards are created? Does product A cost go up, go down, or stay the same? So let me launch this poll. I'll give you about a few more seconds to answer. Almost everyone has answered. All right, I'm going to close the poll. I'm going to share the results. So most people said it's going to increase. Some people said it's going to decrease. Let me hide the results and hide myself. Every time I do a poll, my video pops up. So what's the answer? Okay, the answer is that, this overhead that product B is not absorbing anymore because you're just buying product B. So that the overhead rate goes up for product A. And you can see now when the new standard was recalculated for product A, that product A's standard margin is now less than 30%, which means it should be outsourced. But again, none of the actual costs have changed. We still have the same number of people working here. All the costs are the same. And what happened in this situation is that product A was outsourced. And what happened is that this value stream basically was shut down. This is an actual case study. I for obvious reasons, I'm not going to explain or tell you the name of the company. So what this is an example of is what we call the overhead spiral of death, where you take away products from a value stream, overhead rates go up, margins continue to go down, you continue to either discontinue the product or outsource, and the overhead rates go up, and pretty soon, you're not making any money at all. Okay, and it's all because of product costing. So what's the lessons to learn here when it comes to understanding costs? It's really to properly identify variable and fixed costs. Okay, and what product costing does is it turns, because of rates, it turns fixed costs into variable costs, like direct labor. Okay, people that are very comfortable with product cost, they think direct labor is variable. Why? Because it changes for every product, and that it's based on how much time. And then they think overhead, there's some variability in overhead because it gets allocated based on the direct labor dollars. So and this really is part of value stream costing, but I wanted to bring it up here because it's important to understand when we look at product costing methods. When we look at quoting methods without a product cost. From a lean accounting viewpoint, variable costs change with short-term volume. There's a direct relationship. If you sell one more unit, you incur the variable cost. If you sell less, you don't incur the variable costs. In manufacturing, it's material. Okay, if you sell one more unit, you have to buy the material, you have to produce the product and ship it. Now, fixed costs do not vary directly with short-term volume changes, and they're influenced by management decisions. And in lean accounting and lean thinking, more costs are fixed in lean organizations. Most of your labor costs, most of your machine costs, and your overhead costs. Okay, you think about labor. There is a management decision. You decide to hire people. People leave the company because they get another job opportunity. And then management decides, oh, we have to replace that person. So, that's how the cost changes. There's management decisions, okay, rather than just volume decisions. By the way, the way you control your labor cost is through lean thinking, becoming more productive. So I just want to check, see if there are, I'm trying to find are there any questions? Okay, there are no questions, so we will continue. All right, so we talked about the problems of using product cost and setting a price. Most of that, as I said, is related to this idea that costs are driven by time. And that, that's used in product costing because you have to find a way to assign the costs. But in reality, that's not the way that all the costs behave, except for material costs. So we want to get away from that. So we have to have a new way to do this, okay? Because, you have to, if you quote customers, you have to have a methodology to quote. People have to understand it. They have to use it. And you also have to understand how much money are we making. So what I'm going to show you is two approaches that companies have used. And it is sort of based on lean accounting practices and lean thinking. First, before I show you the two methods, what I like when I talk to companies about this and give them training on this, there's really three questions that everybody wants answered. Number one is, what is the price that we would like to charge to earn the kind of money we would like to make? Okay. And that's really why you go through a quoting process. You besides giving the customer a price, you want to know how much money we're going to make off this. Even if you create list prices and you sort of have standard list prices, you'd like to know, based on this price, are we going to make the kind of money we would like to make? Then there is, what is the price the customer is willing to pay? Now that always is not the same as the price you would like to charge. Okay, and we all know that ultimately customers or the market decide prices. Okay, but the third question you want answered is, let's say that the price the customer is willing to pay is not the price that you would like to charge. What is the profitability of any kind of sales opportunity? So those are the three questions. And really, when you look at using a product cost to set a price, that answers the first question. It answers the third question if they accept that price. Okay. So there's two methods to calculating what I call the desired price. So one is what we call the hurdle rate. So this is a method to evaluate the relative profitability of a product or a service based on the contribution margin percentage. I'm going to show you, if you're not familiar with contribution margin, I'm going to show you what it is in a second. The second is what I call contribution per minute. So it's another way to estimate the profitability or the monetary impact based on the cycle time through the bottleneck of a value stream. Remember, I said that the bottleneck controls the rate of flow. And so what we're going to do is we're going to use the concept of the bottleneck and understand contribution per minute. So let's now look at the hurdle rate. So the first thing to do is, how are we going to calculate the hurdle rate? So you can use your annual budget, you can use some kind of forecast. So you want to know, what are the sales? What are the variable costs? That gives you the contribution margin, okay? What are the actual variable costs? Now, again, we're not using product costs. So like if you're in manufacturing, your variable costs are going to be your materials, okay? And you don't have to get too granular or detailed about this. If you're in some businesses, you may not have variable costs. You may just have fixed costs, okay? Like service businesses. So that's your contribution margin. Then you subtract your fixed costs and you get your profit. Basic equation, okay? So you have your numbers. The next step is step 2 and step 3. You want to calculate the fixed costs as a percentage of sales. And then you want to determine what is the rate of return that you would like to make. What profit as a percentage of sales would you like to make? It may not be what your budget says. It may not be what a forecast says. How much would you like to make? Okay. So you calculate, I'm going to show you an example of this. So these are the steps in the process. Then the next step is you actually calculate the hurdle rate. And it's pretty simple basic equation. It's your desired profit percentage plus the fixed costs as a percentage of sales. There's your hurdle rate. And it's called the hurdle rate because it's what you want to do is you want to achieve this as a minimum contribution margin percentage, and ideally you'd like to be over it. You'd like to jump over it, like jumping over a hurdle. How do you calculate the price from it? You take your actual variable costs per unit. Okay, so you have to look at how you're quoting, what you're quoting, get the variable costs per unit, and you divide the reciprocal of the hurdle rate into the variable cost, and that'll give you the price that you need to charge to cover the variable costs, cover a portion of the fixed cost, and earn the profit you would like. So here's a simple example. And this is polling question number 3. So here we have the numbers. We have a contribution margin of $1.596 million based on a income statement or value stream income statement projection for a truck maintenance value stream. The fixed costs are $616,000. The operating profit of the value stream, $980,000. Okay, so this is a projection. This value stream wants to earn 35% return on sales. Fixed costs as a percentage of sales are 22%. So polling question number 3. What is the contribution margin hurdle rate? 35%, 57%, or 68%? Alrighty, just about everybody's answered. I'm going to close the poll. I'll share the results. The correct answer is 73%. And let me show you how that is calculated. Hold on one second. You simply add up 35% and 22%. Okay. And so what you're going to do with that 57% is you would sort of, if you're trying to calculate a price, as long as you know the variable cost per unit, it's simple math to get that price. So let me show you an example, okay? And you'll have to answer a question here too. So here we have this truck maintenance value stream, and a company that has a fleet of trucks comes to the company and they would like the truck maintenance company to service 500 trucks per month, routine maintenance. Okay, we're not talking about major repairs. There's two value streams here. One is sort of routine maintenance, the other's is major repairs. So 500 trucks per month. What they know from their value stream income statement is that it costs about $17 per truck to do the routine maintenance. The hurdle rate is 57%. So what I'd like you to do is to calculate what the quoted price should be using this formula that you see on the screen. So I'll give you a little bit of time to make sure you have the numbers and you have your phone ready. And then I'll open up polling question number 4. Sorry. Hit the wrong key. So what is the quoted price? $39.53, $38, or $42.15? All right. So sharing the results, 39.53 got the most votes or the most results. That is the correct answer. Let me show you how it's calculated. So we have $17 a truck. We divide the reciprocal of the 57%. 43% is divided into $17 variable cost, and you get the quoted price of $39.53. That $39.53 will cover the variable costs, will cover a portion of the fixed costs, and will bring in the desired operating profit based on what we looked at earlier. But here's the issue, okay? You know, the customer really only wants to pay $38. So then the question becomes, would you accept $38? Is it profitable enough for you, and under what conditions? And we're going to answer that in a few minutes. The first thing I want to do though is show you contribution per minute, then we'll get into understanding profitability. So contribution per minute. Now this again is, it's sort of based on the contribution margin. You have the sales and the variable costs, and you get a contribution margin. And again, you're looking at a forecast or a budget or some kind of projection. So instead of just getting a percentage, like the hurdle rate, what you do is you take the planned volume through the value stream and multiply it by the average cycle time per unit. And what you get is you get a target contribution per minute. Okay, so now we're going to base this on time, not just percentages. So again, this is an average. On average, how much contribution margin per minute do we want to make? Okay. So what you have to do, the next step is understand the average cycle time, okay, through the bottleneck, because it controls the rate of flow. Then when you're quoting, what you do is you understand, based on the product that you are quoting, what is that product's actual cycle time, not just the average, but how much does it deviate from the average through the bottleneck? Because that's going to influence the flow a little bit. So how do you calculate this target contribution margin per minute? You take the target rate here that we calculated in step 1. You multiply it by the actual cycle time from step 3, and you add in your variable costs per unit. And if you want to do a markup on your variable costs, you do. And again, you get a quoted price. So let me show you an example. So here we have a value stream, 57% contribution margin. The annual volume is 58,500 units. The average cycle time through the bottleneck is 10 minutes per unit. So you multiply 58,500 units by 10 minutes, you get a total of 585,000 minutes. You divide the 585,000 minutes into the contribution margin, 1.596 million, and you get an average contribution margin of $2.73 per minute. So how do you calculate a quoted price from that? We have a variable cost per unit of $17. The specific product that is being quoted, its actual cycle time is 8.25 minutes, which is a little faster than the average. So what we do is we take $2.73, multiply it by 8.25 minutes, add in the variable cost, and we get $39.53. And again, looking at the same scenario, let's say the customer only wants to pay 38 at 500 units per month. Would you accept the order? Is it profitable? Under what conditions? So now what we'll do is we will look at that. Okay. Again, we want to understand the profitability of this order. So this is where the lean accounting box score comes into play, where you want to look at the total incremental change to both operating performance, capacity, and financial performance over the time frame of the decision. So you have a current state box score, you calculate a future state box score, and what is the future state better than the current state? Now, the beauty of the box score is that it takes into consideration not just the financial piece, the capacity piece, and the operating piece. So you get a complete holistic picture of overall performance, and it allows you to make better informed decisions. So let's look at this $38 that the customer would like to pay through a box score. So here we have a current state box score. On the top, we have the lean performance measurements. In the middle, we have the capacity percentages, including 7% available capacity, the number of units produced, 4,875. And here we have a simple value stream income statement over the course of a month, and gives us our actual revenue and our actual costs. So the initial calculation is to, factor in these 500 units per month, which you see in the opportunity column under the middle section of capacity. And if you look at the future state column, what you see, and that this is where the blue arrow is guiding you, that there is not, this order uses all the capacity up, all the available capacity up. And from a lean viewpoint, you never want to do that, because if you use all your capacity, if you never have any available capacity, if anything goes wrong, or if there's any variability or problems and issues, or if demand happens to spike, it's going to cause problems serving customers. So you always want some available capacity. So what did this company do? Well, they have to look at options because this is profitable. You can see how much money it's going to make. It $10,500 of contribution per month, but we have to create capacity. So what this company did, one option, they hired more people. Or if we could hire more people. So you can see that hiring more people creates enough available capacity. I mean, you can meet the order and you still have available capacity. So that's good. However, from a profitability viewpoint, if you look at the value stream profit, you're only making about $500 more per month than you were. Now, why is that happening? That's happening because you have to buy the capacity in, how many full-time people are you hiring, and you're buying more capacity than those 500 units then that's needed, which is not a bad thing if you think that sales are going to grow over time. That's one option. Another option is to do continuous improvement. So in this case, the other option was improvement opportunities that could reduce the scrap rate from 20% to 10%, reduce inspection time from 30% to 20%, reduce downtime from 20% to 15%. When you calculate a future state box score based on those improvements, you see that we are creating more than enough capacity to meet this increase in demand of 500 units per month. We're not adding any costs except for the material cost. Our operating performance has improved. You can see productivity has improved, quality has improved, on-time delivery has improved, and inventory and lead time has gone down. So this is good too. This is better and more profitable than hiring people. The question really becomes is, when are these orders going to come in, and what is the level of improvement effort needed to make these improvements over time? So that gets to the final polling question. So based on this example, what would you do if the customer only wants to pay $38 per unit? Would you just not accept the order? Would you accept the order as is? Would you accept the order and hire more people? Accept the order and improve and create capacity, or do something else? All right, I'm going to close the poll, share the results. And I guess what I like about those results is everybody's thinking along like a lean accountant, like a lean thinker. That accepting is creating the capacity is typically more profitable than adding capacity by buying it and adding cost. The real lesson here is that, and I learned this as a CFO back in the 1990s when I first learned about lean, is that you really want, if your business is growing or you have opportunities to grow, you really want your continuous improvement activities to be at a pace where they're creating capacity on a regular basis such that you have sort of confidence you can always accept, orders or you can do quoting and you know that you have the capacity to meet these orders without adding cost. And, you know, if you think sales are going to increase like 15% a year and you got good indications of that, you'd probably want your continuous improvement efforts to try to create more than 15% capacity over the course of a year, maybe 20%. So when you can get into that rhythm, this really creates the financial leverage of lean, and you make a whole, as you can see here with this example, you make a whole lot of money because the incremental profit of the new business is the contribution margin. You're not adding any more costs. Now, you know, in the long run, eventually you're going to, you know, have to add more people or have to buy more machines. But again, continuous improvement is very, very profitable. So let's wrap things up. First of all, you're going to get a survey as soon as I end the webinar. Please complete it, or complete it when you get the follow-up emails tomorrow. If you would like a CPE certificate, again, please write me and I'll be able to send it out in a few days. I talk about this a lot in training. The numbers that people use in analysis and decision-making drive thinking. And those thinking patterns drive behavior. The behavior drives the decisions and the decisions drive the number. It's sort of like a cycle. So, you know, think about this. You know, we talked about product costing at the beginning. And product costing drives a certain type of thinking. Oh, labor's variable, the overhead, you know, and the longer it takes to make a product, the more expensive it is, and the higher a price we need to charge to make the kind of money we want to make. And like I said earlier, that gets into a lot of internal discussions about, you know, labor rates, overhead rates, and, you know, run rates, things like that, where people who are trying to understand the profitability, they know they can't charge a higher price because they have a general idea of what the market will bear. So they're trying to reduce the cost of that individual product to get the standard margin they'd like to make. And again, you might change something in your cost allocation system to reduce the cost of one product, but it's not a real cost reduction to the company. And like I said, there's a good chance that, you know, using a product cost will make you may make a wrong decision in pricing. You price it too high, price it too low, or maybe just turn down the offer. So again, we all understand pricing is set by the market, and it's based on the value that a customer perceives or customers perceive. But we still have to quote a price, okay, or we have to create list prices. So again, we don't want to use cost plus pricing because it leads to poor pricing decisions. You know, focus on contribution margin or contribution per minute to calculate a desired price. And if you want to understand the actual profitability, focus on box scores, okay? And the future state box score is based on the incremental change over the time frame of the decision. So if you're looking at, for example, a one-time quote, okay, just one order, okay, the time frame is very, very short. You know, in terms of your capacity needs, you probably can get the order in. But if you're looking at how many more units per month, then you have to expand your thinking and look over the course of time. So I'm going to put up upcoming events. Okay, there's a Solving the Standard Costing Problem workshop tomorrow. It's 3 90-minute sessions that begins at 11 a.m. Eastern time. You can still register for it if you want. There's the link to register. If you haven't already, bookmark our events page, where you can get a list of all upcoming events, webinars, workshops, conferences where I'm speaking or doing workshops. We have a webinar scheduled September 13th. And then in the next few weeks, I'll be posting webinars for October, November, December. We have our Lean Accounting Community Chat, free to join, free to attend. There's the link. It's going to be this Thursday. That link gets you to all the chats. And then in September is the virtual Lean Summit, which is going to be September 19th to the 22nd. I'm going to be doing 2 pre-conference workshops. You can see the dates and the times there. I'm also going to be doing a Building the Box Score Cornerstone class on September 20th. Go to the Lean Frontiers website. You can register for the summit and all of these events. So I gotta find my mouse, and there's a couple questions. So Sonia asked one question where she said that she noticed that contribution margin in these examples are only considering material costs as variable. In manufacturing and in lean accounting for manufacturing, yes, material is considered the primary variable cost. Now, again, if you can specifically identify some other variable costs and get it down to the unit, you can do it. This is where you can say, well, supplies are variable. Yes, supplies are variable based on total volume. Okay, if you can't get it down to a unit, how many specific supplies do we use all the time on every order, and get it down to a per unit, it's probably not worth trying to make it a variable cost. Now, things like overtime, temporary labor, things like that. Again, it varies, but it doesn't necessarily vary per unit. So again, if you adopt the definition of fixed and variable costs that we talked about, it becomes a whole lot easier. So I hope that answered the question. So that wraps things up. If you have any other questions, please feel free to contact me. Be glad to answer any questions. And I hope that I see you on some future online events and maybe even some live events. So all of you have a good day, and we'll be seeing you soon. Bye.